and welcome to yet another episode of Legal Wrangle on International Taxation. In this episode, we present before you cases relating to treatment of liaison office established for purpose of export as PE, treatment of service fees as FTS, applicability of MAT provisions on foreign companies, treatment of ex-gratia payment as profit in lieu of salary, consummation of Section 50C upon execution of agreement to sell and entitlement to set off of brought forward losses consequent to reduction in beneficial shareholding. The key issue in our first case is whether a liaison office of a non-resident company established in India can be treated as its PE when such liaison office was created only for purpose of carrying on business of purchasing goods for the purpose of export. The assessee is NW Science Park Drive, Portland, engaged in the business of designing, developing, marketing and distributing outdoor apparel. Now let's go to Maneet for details of the case.
The assessee had established a liaison office in Chennai for coordinating purchases from third-party Indian vendors on principal-to-principal basis. These offices were not involved in any commercial activity or industrial trading. The revenue authorities, however, presumed that the manufacturing activities were carried out by assessee itself in India in relation to the products purchased in India, and therefore the Indian Liaison Office constituted a PE of the assessee in India, and income attributable to the same would be taxable in India.
The High Court concluded that a liaison office of a non-resident company established in India cannot be treated as its PE for imposing tax liability, where such liaison office is established only for purpose of carrying on business of purchasing goods for the purpose of export. Such activities, in fact, fall within the meaning of collecting information for the enterprise. Accordingly, no income can be attributed to the said non-resident entity. In our second case, the key issue was whether service fees paid by an Indian company to its foreign subsidiary for providing market research and consultancy services outside India can be taxed as fee for technical services in India. The assessee is Guangzhou Usha International China, engaged in rendering services relating to business of household electrical appliances and accessories to the Indian company. Now let's go to Maneet for details of the case.
The assessee entered into a service agreement with its Indian holding company, that is UIL, for providing services relating to procurement of goods by UIL from vendors in China. The UIL accordingly paid service fee to assessee after deducting TDS at 10%. The assessee filed an application before the Authority of Advance Ruling urging that its income on account of rendering service to UIL was not taxable under Section 5 of Income Tax Act on the ground that such payment was not covered under the definition of FTS since no services were rendered in India.
The Authority for Advance Ruling observed that the assessee was not only procuring goods but was also generating new ideas for UIL after conducting market research, which can only be given by an expert in the specific area. The AAR therefore held that nature of these services in a specialized field would surely come within the ambit of the term consultancy services and hence was liable to be taxed in India. The assessee was thus obliged to withhold income tax at appropriate rate. In our third case, the key issue is whether provisions of Section 115 JB can be applied to a foreign company where such foreign company is a resident of a country having DTAA with India, although having no PE within India. The assessee is a Castleton Investment Ltd, incorporated in Mauritius and holding shares in an Indian listed company. Now let's go to Maneet for details of the case.
The assessee had proposed to transfer its investment in the Indian company at fair value to its AE in Singapore through an off-market transaction. The Authority for Advance Ruling held such transfer of shares was chargeable to capital gains in India, and the fact that foreign company had no PE in India will make no difference to the applicability of MAT provisions.
The Supreme Court observed that CBDT's circular dated 2nd September 2015 states that MAT provisions will not be available to FIIs and FPIs not having the business or PEs in India for the period prior to 1st April 2015. This was followed by press release dated 24th September 2015, wherein it was mentioned that MAT will not apply in case of a company resident of a country having a DTAA with India and not having a PE. The Supreme Court further noted that a statement was made at the bar that government would abide by the decision taken in aforesaid circular and press release. The parties having agreed that in view of the above, the appeals can be disposed of in terms of the same. In our fourth case, the key issue is whether ex-gratia payment made by an employer out of his own sweet will can be treated as profits in lieu of salary under Section 17(3)(I) of the Income Tax Act. The assessee Arunbhai R Naik was assessed as an individual and his return was processed granting refund. Since the refund was more than Rs 1 lakh, the case was taken up for scrutiny. Let's go to Maneet for details of the case.
During assessment, it was found that assessee had received ex gratia compensation on premature cessation of his services. He claimed such sum as capital receipt and hence not liable to tax as the same was not paid as retrenchment compensation either under labour laws or under the terms of employment. The assessing officer, however, denied assessee's claim and added the same to the total income of the assessee.
The High Court concluded that if the payment is made ex gratia or voluntarily by an employer out of his own sweet will and is not conditioned by any legal obligation, whether on sympathetic reasons or otherwise, such payment cannot be treated as profits in lieu of salary under Section 17(3)(I). The High Court further held that the manner of computation of the amount payable to assessee in terms of the settlement would not change the character of such payment. In our second last case, the key issue is whether transfer for purpose of Section 50C stands consummated and provisions of 48 come into play as soon as agreement to sale is executed and part consideration is received. Assessees are co-owners of land which was mortgaged with SBI Agra for loan taken by a firm wherein assessees were partners. On account of non-payment of outstanding dues, a civil suit was filed by a bank for recovery of the same. Let's go to Maneet for detail of the case.
During pendency of recovery proceedings, the said land was transferred to subsequent purchaser. Part consideration received by the assessee were paid to clear liabilities to SBI and accordingly the bank released the mortgage property. Thereafter, consequent to execution of sale deed return of assessee already processed under Section 143(1) was reopened determining the long-term capital gain under Section 50C.
The High Court observed that Explanation 2 to Section 247 added with retrospective effect provides that transfer of asset includes disposing of or parting with an asset by way of agreement. Therefore, the moment an agreement to sell is executed and part consideration is received, transfer for purpose of Section 50C take place and computation under Section 48 will start for purpose of calculating capital gains under Section 45. The High Court noted that transfer of property took place in 2001 when the provision of Section 50C was not in existence. Consequently, it was held that computation of capital gains under Section 50C cannot be sustained by way of reopening. In our last case, the key issue was whether entitlement to set off of brought forward losses can be denied consequent to reduction in beneficial shareholding, even where voting power of such entity together with its wholly owned subsidiary continues to be 51%. The assessee is Amco Power Systems Ltd, engaged in manufacture and sale of storage batteries. Let's go to Maneet for details of the case.
The assessee was granted non-exclusive license for technical know-how to manufacture and sell batteries on payment of lump sum consideration for license to use the said technology. It had filed the return declaring nil income after claiming set-off of brought forward losses of earlier years. The assessing officer, however, denied such losses, considering the change in beneficial holding of 51% as provided under Section 79 of the Income Tax Act. On appeal, the tribunal, however, allowed the benefit of set-off of brought forward losses.
On further appeal, the High Court noted that Section 79 restricts the benefit of set-off of brought forward losses to companies having 51% voting power. The court observed that though there was a change in shareholding pattern of the assessee, yet there was no change in its control as the parent company, along with the assessee, retained shareholding at 51%. Therefore, provisions of Section 79 could not be invoked for denying the benefit of set-off. Well, this brings us to the end of this episode of Legal Wrangle on direct and international taxation. You may write to us your comments, criticism and counsel at editor@tioltube.com. Please do subscribe to the TIOL Tube channel on YouTube. It's free and will keep you updated on our new posts. Have a good day.